Hi guys, can you please confirm if you can? Okay, I can see it streaming. Hi guys. Hello everyone. Hi Neha. Welcome to all of you for day 2 of the financial modeling session. Hi Ashwin. Hi, can you give me a heads up and confirm if the audio video is all right? You can hear me, see me properly. Is everything okay? All right. Hi Akhil. Yes. Hi SS. Deba Malya. That's a tough name. Rishabh, Siddharth, Divya, Akhil, Soham. How are you guys doing? How is everyone? Hi Mohit, Ashwin, Mr. Sai. Yo to you as well. All right. A lot has happened in the markets in the last 1 week. Uh, it is it is quite interesting, right? On the index level, we've had some extreme days. Hi Pranav, Muskan, Soham. Can you please type in the name of the city you guys are attending this session from? Just type in your location. Let me know where you're attending this session from. Pune, Mumbai, Vadodara, Pune again, Nagpur, Kota, Rajasthan. That's a place famous for something else, isn't it, Neha? It's an IIT's hub. Guwahati, Nairobi, plenty of Pune and Mumbai, Suratgarh, Ahmedabad, Bhiwani, Haryana, Vadodara, Toronto, Navi Mumbai. There's one more Kenya, I think it's the same person. Appala Pune, Coimbatore, Kathak. Where is Kathak? Hyderabad. Lima, Peru, of course, Lanson. Welcome back. Astana. Oh, Gulmira, nice to see you. It's been a while. Hi, Rishabh. Jodhpur, Assam. Fantastic. Great. So here's what we'll do. First 5-10 minutes, let's talk about markets in general. We'll have some general discussion on what's been happening in the markets. I think it'll be cool to talk about that. Okay, Dhaval, very kind of you to say that. Thank you very much. Aurangabad. That's my city, sir. Sarvesh. I don't know if you know it. All right, Rohit. So yeah. So what do you guys think? What do you guys think is happening in the market? It's been crazy, right? My portfolio is pretty much red. It looks like it might be this way for a while. Clearly, inflation overhang, something that central banks are worried about. They want to increase interest rates, but no one really knows what's a good number, right? At where do you stop? Clearly, it's going to have some sort of an impact on growth. Also, interestingly, what central banks are dealing today. Okay, we have someone from Egypt as well. Nice to have you, Mohammed. Because of you, I qualified for level 1. Thank you very much, Hemant, for saying that. Yeah, and see, world has never experienced this before. right? I mean, yeah, every crisis there is something new. But the kind of crisis we are experiencing, the level of currency which has been printed by the center, it's a problem created by central banks on their own. That's kind of a given. But the world hasn't experienced that. The kind of money which has been printed, there's no playbook for this. So we don't really know in what direction it's been heading. What I've been doing personally with my own portfolio is I've, I've I stopped buying about 4 months ago. I haven't been haven't been buying into the markets. Uh, but I think, it's a fool's exercise to time the market, right? I mean, I believe it's very difficult for someone to figure out what's the bottom of the market. We don't even know if the bottom is this year or next year. But I think starting from next month, slowly, I'm thinking I'll start buying. I have a list of stocks that I want to buy at a purchase price, right? So I have certain prices in my mind, and the moment stocks hit those prices, I'll probably start buying in a piecemeal fashion, fully knowing that there would be a 10, 15, 20, 30% notional loss on the books. But again, I don't know if you've heard this very famous quote from Peter Lynch, that more money has been lost by people waiting for recessions rather than recession itself, which means in a simple language, no one really knows how to time the market, right? So the smartest thing to do here, your best friend in these markets is SIPs. So keep on buying in piecemeal fashion when you find attractive prices. That's how I'm thinking about approaching this. Anyway, so good. So now I'm going to start with financial modeling day 2. If there's anyone who's attending the session today and you could not attend day 1, that's okay. The first 3 sessions are kind of going to be independent. So you can sit through the session, get hold of your concepts, and then you can go and watch day 1. And that would be all right. In the previous session, what we did is we spent time on income statement. And on today's session, we're going to spend time on analyzing balance sheets, and then we're going to look at a variety of different ratios with respect to the balance sheet. It's going to be fun. I would be showing you a lot of balance sheets, and my hope is, expectation, apeksha, is that by the end of the session, all of you should be able to read balance sheets of listed companies and feel very, very comfortable, and then maybe also learn to analyze them with time. All right, so with this background, I'm going to get started. Let's set up a nice file for ourselves for the day. All right. So what's a balance sheet made of? Anyways, right? Why there is so much of fuss about balance sheets? What is it made of? It's made of firms' assets and liabilities. All right, assets and liabilities. Why do you need to know about balance sheets when you're analyzing stocks or when you're modeling companies? Because that gives you a sense of, that gives you a sense of the financial health of the company. So when we are analyzing companies, if I want to analyze a company for this particular year, right, I want to look at what is their performance as of now for this particular year. We would look at P&L. But when I want to analyze the health of the company, right, how has the company done over a period of time, then the numbers that I want to look at is the balance sheet. Now, a lot of times you find something, some stuff which is really, really interesting on balance sheets. So the way we're going to do today is, first, I'm going to explain you how balance sheets are built, simple, straightforward. Then we will set up 1 or 2 very basic elementary practice questions on balance sheet so that we understand the theory. And once we've understood, the background, then we will go and start downloading balance sheets of a ton of different companies and start analyzing them together. So that will be fun. But here's how a simple structure of balance sheet is. So you'd find typically balance sheets are broken down into two sections. There is one section which is called equity and liabilities. And then there is one section called assets. Right now, a very easy way to think of this is that whenever you want to start a business, you have, you have two sources of finance, right? And you have two possible ways in which we can raise money. One, the owners of the business putting in their own money, right? So when owners of the business put in their own money, we typically call this as equity. So let's say that owners of the business put in their own money, and we'll say that's 1,000. I'm just making up a number. But maybe that's not sufficient for you to start your business. So what do? So then you go to bank and maybe you take some sort of a loan, right? So when you take a loan, we typically say these are outsiders liabilities. So we call them as debt. And there are different ways of doing it, but debt. So let's say there is another debt of 500 here. So these two collectively, which is your equity and debt, you can think of them as the sources of funds. Where am I getting my money from? So that's your sources of funds. So you're getting your money from two sources here. Little bit of money is coming through equity, little bit of money is coming through debt. You take all that money and then you deploy that into different assets, right? So what kind of assets? Let's say something like, property, plant, and equipment. All right. So we typically call these numbers as PPE, property, plant, and equipment. Let's say you put in about 800 here. Then you go and buy some inventory. And let's say you put in, I don't know, maybe another 500 into inventory. And then you keep a little bit of amount in cash with yourself. That's 200. And there you go. That's your balance sheet. It's as easy as that. There's no complication whatsoever. Typically, one side shows you, how you've raised money. So that's your sources of funds. The other side shows you how you've used money. So this is your application or uses of funds. All right. And then accountants get a high when they do something. Can you tell me what word is that? Accountants kind of go crazy when something happens. Accountants celebrate when they're able to do something. What is that? What's the word? The word is tally, right? So accountants feel really, really happy when they're able to tally the books. And what do you mean by tallying, right? So it's simply the total on the left hand side is same as the total on the right hand side. So accountants kind of go and celebrate. They say, you know what, we've been able to tally our books of accounts, we've been able to tally our balance sheets. And why wouldn't it, right? Because at the end of the day, if you're getting funds, you're going to do something with them. So obviously sources of funds are going to tally up with the uses of funds. That's it. It's that simple, right? Now with this background, we would go and start looking at different types of balance sheets. Let's go and take the first company for today. This one I'm going to choose myself. I'll first go to screener.in, search for a company called Tata Coffee. All right, and we'll go and download the annual report of this company. I was invested in this company a few years ago, and I'll show you why. But then I realized I was making some sort of a mistake, and I exited, after a few months. All right. So here is the annual report. Now, annual report, we're going to go and look for consolidated books as against standalone books. What does it mean? What's the difference between consolidated and standalone? Can anyone tell me what's the difference there? Standalone versus consolidated. How are consolidated different? Consolidated means if if think of it this way, that if there is a large company, okay, then the financial statements of the main company is called standalone. But if there is a large company and they have a lot of subsidiaries, okay, when does a company become your subsidiary? When you own more than 51% of that company, okay, you own more than 50% of that business. So when you prepare a books of the combined entity, all of them combined, all of them together, then that's referred to as a consolidated balance sheet. So for the timing, we're going to look at the consolidated books of Tata Coffee. It should be interesting to see this. Balance sheet is on page number 184. So that's where I'm going to go. 184. Here we go. This is your consolidated balance sheet. This is given in rupees in lakhs. Lakhs is nothing but 100,000s. Okay. First, we will read all these items together. And then I will start showing you how to analyze these balance sheets and what to look at and what kind of ratios we generally calculate. Let's start looking at this piece by piece. First thing that you notice, see what we have here. We have assets. Okay, so that assets, this is assets. Now, when I give you an example, I created a horizontal balance sheet, which means I wrote assets and liabilities next to each other, left, right. Whereas most of the companies, they will give you vertical balance sheets. Concept is same, but they'll write them, one below another. So these are your assets and these are your equities and liabilities here. Okay. Now, the first thing that we want to do, whether the accountant sitting at Tata Coffee has he or she been able to tally their books, right? So let's look at the total of assets. The total of assets are 368,869. Okay, this is the number you want to look at, 368,869. If I go and look at the total of equities and liabilities, that number is 368,869. Right. So obviously accountants must have celebrated because they tallied the books. Of course, I'm exaggerating. I hope you get that. There are softwares which will do it for you these days, right? But the total of assets and total of liabilities are tallying with each other. All right. Let's start looking at each of these assets. What we have first is called as a non-current asset. Okay, so that brings us to classification of assets. There are certain assets, we call them as current, versus there are certain assets which we call as non-current. So current versus the non-current assets. What do you mean by them? What's the difference between current and non-current? Who will tell me what does non-current mean? So very easy layman way of thinking this is non-current are typically, long-term assets. Okay, whereas current is typically short-term assets. Now, how do you determine what's a long-term, what's a short-term? So we generally use a yardstick of 1 year. So we say that if anything can be converted to cash within a year's time. Okay, so anything that can be converted to cash within a year's time, then it becomes a current asset. Now, generally, any asset which you plan to keep on with yourself for a longer period of time, we call them as the non-current or long-term assets. All right. Now, 1 year is a good reference point, but when we get a little technical, I'll explain this in a little more nuanced way. But for the time being, easier way to think of this: current versus non-current. Think of non-current as a long-term assets, current as a short-term assets. All right. So let's go back to Tata Coffee here. The first asset we have is property, plant, and equipment. The value of this asset is 85,795. Property, plant, and equipment will typically include most of the important business assets that the firm will have. So it will include your land. It will include, now it's an agriculture company, so coffee plantations. They have some manufacturing facilities in some coffee manufacturing facilities, I think in Vietnam, but I'm not sure, but they have facilities outside India. So the total of all of them is here. Then we have next item, which is called capital work in progress. I hope you can see this number, capital work in progress. That number is about 7,000. Again, an easier way to think of this is, it is a asset, it is a property, plant and equipment, but not ready yet. Okay, what do we mean? Just think of it this way. Imagine you're constructing a plant for yourself, but the plant is not ready yet. Okay, it's half done. So in that case, how do you call it? Do you call it property plant, or do you call it capital work in progress? You call it capital work in progress. That the day that asset is completed, the manufacturing is completed, the construction is completed, then it gets transferred from CWIP to PP. Then we have a right of use asset. Now, this is a relatively new accounting standard. This is a little technical, so today's session I'll avoid getting into it. We'll deal with it when we get into our own detailed modeling lessons. But it's a technical asset created through certain leases, and we'll explore this as we progress further in this course. Then we have investment property. The name itself tells you it's some property that they have purchased for investment purposes. Then we have a goodwill. Goodwill is an intangible asset. Intangible means we can't touch it, but we know that the asset exists. And the reason why I chose Tata Coffee for you is because I wanted to show you this number. Can you see the amount of goodwill on their books? Right? Out of the total assets that we have here, look at the value of goodwill. It's huge, right? It's almost more than half of the total non-current assets, and it's about 1/3 of the total size of the balance sheet. So goodwill is a very, very large number in this books. Then we have financial assets, we have some technical tax adjustments, and then we have other as a category. Most of the balance sheets you'd read, you'd always find these other items. Now, each of these items, when you want to go and investigate in depth, you can go and refer to these notes to accounts. For example, if you're curious about knowing what is other intangible asset, okay, what is other intangible asset, all that you need to go is go and read note number 3, which is typically in the pages below, and then you will get a more detailed explanation of this, and we do it. Then we come to current assets. Inventories including biological assets. That's cool, right? Biological assets. In case of this firm, it would simply be the coffee plantation or the coffee plants, right? So that has been classified, and look at the size again. It's a fairly large asset. Then they have financial assets, investments, trade receivables. Trade receivable means you've sold assets, you're expecting to receive cash, bank balances, loan, other, and then non-current assets held for sale. So it's a non-current item, but they're planning to sell it. And that's how you have a total of 368869. All right. Then we go to equity and liability side. What do we have on equity? We have equity share capital. We have other equity. A total of these two items, okay, is called as a equity combined. In fact, there's a third one also called non-controlling interest. So we take total of all of these, and this gives me equity. How do you read this number? This is the amount that owners of the business have invested, or the amount of profit has been, or the amount of profit which has been reinvested in the business, a combination of the two. So A, when you started the business, how much amount you put in, that's equity. Second, over the period of time, you make profits and you keep on reinvesting those profits in the business. Total of this is this number. So which is about 202,000 here. Then we have non-current liabilities. Again, the same distinguish, the same difference. What do you mean by non-current liability? It means a long-term liability. Okay, so what do we have here? We have borrowings, which is nothing but loans. We have certain technical liabilities here called the lease liabilities, some other liabilities. Then we have provision. Okay, what do you mean by provision? So in a simple language, let's say that I promise my employees that, hey guys, when you retire, I will cover for some of your expenses with pension. So my employees will retire with, 10, 15, 20 years from now, but I've already made them a promise. So it's like a liability for me. So I have to create a provision for it. Okay, so some expense that you need to pay in the future, but today it's a liability. So these are your provisions, and there are different types of provisions. And then a technical item on deferred tax liability. So these are your non-current. Non-current means long-term. Long-term means I don't have to pay it this year, but I don't have to pay it within a year, but at some stage I'll have to pay them. Then we have current liabilities. Short-term loan taken from a bank. Look at this, we have borrowings. Then we have lease liabilities. Okay, again, slightly technical item. Then we have trade payables. Trade payables क्या होता है? What is trade payables? Uh, you've taken, you know, you've taken goods on credit. Okay, you need to pay them. Udhari, right? You've taken certain goods on credit. You would have to pay them. You've taken goods on credit from small companies, big companies. This is the classification here. And then we again have provisions, and then we have other item, and that's how we get the total. Okay, so this is your first balance sheet here. Now, what we're going to do today is we're going to learn a nice and easy way. We're going to learn a nice and easy way to analyze balance sheet by creating something called as a vertical balance sheet. Okay, so that's going to be our first agenda today. And to do that, we will have to convert these financial statements into Microsoft Excel. So all of you can do this along with me. Open an Excel file and then start copy pasting together. I'll show you how to do it. And once we are done, then I'll show you some cool Excel tricks. And then with the help of those Excel tricks, we'll be able to build our vertical balance sheet today. All right, so let's start this right away. Everyone, please confirm if you're ready to do this on Excel. Just give me a ready on the box. Okay, my chat box is not up. Okay, finally it does. I think there's a lag of about 30-40 seconds with YouTube. Fair enough, nice. So fire up your Excel file and let me fire up mine. All right, here we go. Now, I'm using my Excel on a MacBook, so it might look slightly different, but the usage will be more or less same. The first thing I generally do when I open an Excel file is I get rid of the grid lines. Okay, because I find it easy to work without the grid lines. Okay, so if you want to do it, if you're on Windows machine, you can press these hotkeys. You can press Alt W VG. So sequentially Alt W and then VG. If you press them, automatically it will get rid of the grid lines. I don't know the shortcut on MacBook. I just use this navigation. Go to View, go to grid line, and just select, unselect. That's it. It's simple. Okay, you don't have to do this. Something that I'm comfortable with. All right, so I'm going to throw in the heading here. Just give me a minute. Let me get comfortable. So we're going to type in consolidated balance sheet of Tata Coffee. I'm going to throw in the heading here, consolidated balance sheet Tata Coffee. Right. Now, the first thing that we do, stuff, is copy this particulars. Now, if you're using an Adobe PDF reader, you can try holding Alt button and then select. There's a chance that you'll be able to select only the relevant data like this. Okay, and then maybe you can copy paste everything in one go. Okay, if you hold Alt and select, I'm using a MacBook. I don't know how to do it, and I'm okay doing it one by one. It also makes you a little more comfortable with numbers. So we have particulars, then we have assets. Okay, I hope you're doing this with me. It should be fun. Then we have non-current assets. Non-current assets. We have property, plant, and equipment. Okay, I'm holding the button. I wish it would let me just copy paste. Okay, I'm holding the Alt button, or on my MacBook, I'm holding the Option button. I'm going to try and see if I can copy paste everything in one go. Not going to work. Okay, so let me just copy paste them one by one. Property, plant, and equipment, capital work in progress. I told you last class, there's a cool tool with Amazon called Textract. So when we'll be modeling the data, we'll make use of that tool. This thing in financial modeling world is called hard coding. And it's a good skill to have, right? To be able to hard code numbers accurately. Hard coding is simply a copy paste exercise, nothing more to it. So I'm just copy pasting them one by one. Just doing it vertically. Be with me, do this, you'd enjoy. Once I show you the formula, you're going to have fun with it. It will also, you would have your Excel file with you. It will be very satisfying. I'll share my file in the description of this video at the end of the session. So in case if you want to refer to it, you should be able to do it. All right, simple Control C, Control V, nothing more to it. Simple, straightforward business. Then we go to current assets. Inventories with biological assets. Then we go to financial assets. Investments, receivables. This should be fun. Balance sheet copy paste work is generally lengthier because there are too many items. Cash and cash equivalent. Other bank balances. Loans. Now, when you start doing this, initially it will take you a little more time, okay, because it requires a certain level of practice, but it's okay. Try to do whatever you can. If you're able to keep up pace with me, that's great. If you're able to do faster than me, that's fantastic. But with a little bit of practice, you would get all right. Okay, so I'm done with the asset part. So total assets are done. Where have you reached? I haven't put in the numbers yet, just copy pasting. No numbers yet. They've reached up to the assets level. Now I'm starting with equities and liabilities. Equities, equity share capital, other equity, A lot of times in financial modeling world, you have to work with financial statements of private companies as well, like unlisted companies. A lot of times these documents come in PDF formats. So it's always a good skill to be able to do this. This is typically a job of an intern, not an analyst. Okay, I'm done with equities. I'm going to liabilities now. Borrowing, lease liabilities, just simple Control C, Control V to rotate between the two tabs. I'm using on my MacBook Command tab. On your Windows, you can do Control tab, right? Control tab will allow you to move between files super fast like this. All right, provisioning, reaching towards the end of the balance sheet here. Deferred tax liabilities. Let's see who is able to do it fastest. The one who's done with the whole balance sheet first, give me a done. Don't lie, be honest. Borrowings, lease liabilities. Those of you who come in late, we are hard coding Tata Coffee's balance sheet for the current year. Divya, that's fantastic. Are you done with all the numbers? That's super impressive. Yeah, those of you who come in late, we are going to analyze balance sheet of Tata Coffee today. So right now we just hard coding the financial statements. It seems like a, it seems like a, really old thing to do manual work, right? Software should be able to do it. But the companies that I invest in, I like to do this process myself. Like every company that I invest in, I manually hard code the numbers and build my own models. Because that allows you to spend time with the numbers and make you very comfortable with what's there in the books. Jesse, that's a point we're going to discuss. Keep it on hold. That is definitely to be discussed. All right, so I'm done with hard coding the headings. Now I need to start putting the numbers. What I'm going to do in column B is I'm going to leave it for support/comments. I'm not going to put in any number here. And in the column C, I'm going to put in financial year 2022A. Okay, so again, in the modeling world, we have this practice where we distinguish forecasted numbers with actual numbers. So typically with forecasted numbers, you would see something like an E here. Okay, had this been forecasted, but because we're dealing with actual numbers, I generally type in A. Some analysts don't do anything. They just type in A. They just type in actual numbers as it is, and then forecasted number is E. Some analysts do A and E both. So you can figure out what works for you. All right, I'm going to start copy pasting the number now. Property, plant and equipment. I don't want to get my sequence wrong. Then we have capital work in progress. Let me see if I can copy paste them in one go. Okay. Not working, unfortunately. Right of use. Investment property. Then we have other intangible assets. Sorry, after that we have goodwill. Then we have other intangible assets. If I make a mistake, help me out. Please keep an eye on the numbers. Then we have investments here, 11.28. Then we have loans here, 20.98. Other financial assets, 36.83. Non-current assets. No, what is this? Non-current tax assets. And then finally, we have other. What is this? Yeah, this other non-current assets. There we go. This part is done. Simran is already done. That's great job, Simran. I'm going to do inventories now. Right, there we go. These are your inventories. Then we're going to do investments, trade receivables. Then we have cash and cash equivalents. Then we have other bank balances here, loans, other financial assets, 6443. Then we have other non-current assets, 4365, and the assets held for sale, which is 49.90. All right. Now I need to take total of the entire asset side. Okay. Now, by the way, one thing again, I should have shown you earlier, but you can go to view again, and then you come on this particular cell, which is right below the first column, and then you can click on something called as a freeze pane. Okay. Why do you want to do it? So that when you scroll downwards, you still see the headings. All right. So once I've done all the assets, I'm going to run a sum formula. I'm sure you know how to do it. Is equal to sum, bracket open, and then just select the whole range. Make sure you select all the numbers. And then the sum formula will give you 368869, which is matching with the number that we have here on the balance sheet. Right. So one side is done. Now we'll start with the other side. All right, equity, share capital, other equity, then we have, what is this? Sorry, I think I'm having some trouble with my eyes here. What number is this? Non-controlling interest. All right, then total equity. I'm not running the total just yet. Then I'm going to take borrowings, which is 50. So here we go. These are my borrowings here. Then I will take lease liabilities. If I put in subtotals, I can't run a sum formula on the total, right? So I'm just being a little careful there. Then we have, I think, other financial liabilities here. Deferred, this is provisioning number, right? Provisioning, okay, and deferred tax is this much. All right. Then we'll go to financial liabilities. The first item we have is borrowings. So I'm taking the borrowings here. Then we have lease liabilities. So lease liabilities is this. Payables, 69.51. Then 17,000. Okay. Then other financial liabilities. Then we have short-term provisioning of 272. Then we have current tax liabilities of 340.79. Other current liabilities of 1735. and we're done. I just need to run a sum formula here. So let me take a total of all the equity and liabilities here. And there we go. This balance sheet is not matching because I think I might have taken some subtotal somewhere. Let me check the numbers again. Equity is all right. Other equity is okay. Non-controlling is gone wrong. Non-controlling, fix it. And now the total seems to be matching. There we go. Done. Okay, so all of you try and finish this and be with me here so that we can start doing some further analysis. Are we together here? Please let me know once you're done. I'm waiting for you. Then we will do the subsequent analysis together. I can see a few people are done. I think we should wait for others. Jesse is done as well. That's fantastic. You guys are Excel ninjas or copy paste ninjas. Either way, copy paste is a survival strategy, right? Thank you for the feedback, Hardik. All right. Now I'm going to assume that all of you are done. Do you want me to wait? Do you want me to show you the next steps? Those of you are not done, can you please type in the percentage of completion so far? 50, 60, 70, 10, 5. Where are you guys? All right. So assuming you're okay with this, here's what we do next, right? So now what we're going to do next is we're going to do a vertical analysis. Everyone be with me, even if you're not done. Okay, Siddharth, whatever you've done. Ashwin needs a few more minutes. Okay, you know what? Just let me just show you how this is to be done. Watch this carefully, then you can finish it. I'll be giving you a break any which case. Okay, this should be cool. Look at this carefully. Vertical analysis. Everyone, observe the formula. This is the fastest way to analyze balance sheets. Okay, and in fact, that's true even for income statement. Every time I decide that I need to analyze few numbers and I want to do this quickly, I refer to these vertical analysis. Vertical analysis of both income statement, balance sheets. At times I also do cash flow statement on them. A very, very useful trick to know. Okay, and if you get your data in Excel, typically in the investment world, you would have databases which will give you this, or you have interns which will do it for you. So every time you do this, This is every time you get your Excel file with hard-coded financials, this is the formula you want to write. Observe carefully. Let me zoom this for you. So your formula is going to look like this. E is equal to, okay, E is equal to, take the number on your left, so left arrow, divided by, so you want to divide every number with the total here, which is 36889. Okay. Now, when I copy paste the formula, what will happen is Excel will apply its own logic. Excel will apply its own logic and it will keep on changing your denominator. You don't want your denominator to change. You want only your numerator to change. So now focus here in my formula bar, or let me just kind of come back here. Focus here. What I'm going to do is I'm going to put a dollar sign in front of 30. Okay, this is called as a freeze and this is a relative freeze. If you're on Excel, you can press F4 2-3 times. One of the times the dollar sign will automatically come here, but you should press F4 after selecting this. Okay, so you can try it that way or just manually go and put in a dollar. So what is the meaning of that dollar? Now that row 30 has been frozen. So when I copy paste this formula, my numerator will change based on the Excel logic. What is the logic? Take the cell on the left. My numerator will change, but my denominator will always remain from row 30. All right. And with this, I'm going to hit the enter button here. And it's showing me 23.2590. Okay. Now, obviously, I don't like the way it looks. So either you go to home and you select the percentage manually like this. Okay. That's one way to do it. Or you can go to that cell. Okay, let me show you. Select that cell and you can press Control, Shift, and Percentage, all the three buttons at the same time. So you can press Control, Shift, and Percentage to change the format of the number. Okay, whichever way works for you. So what is the meaning of this? Property, plant, and equipment is 23% of the total size of the balance sheet. Now, see the formula one more time. C6, the cell on the left, divided by C30. And what is the C30? C30 is nothing but the total assets. All right. Now, once I have written this formula, all that I need to do is copy that formula and paste it here. And Excel is smart enough. It will understand, take the cell on the left, divide that with total. Notice the denominator is coming from row 30 always because we froze it. Okay. And then again, Control C, Control V, and I'm going to do this for the entire range. Right. I'm just going to keep on copy pasting this wherever there's a number on the left so that we can quickly analyze the books. Okay. And I'm going to do this here as well. Since total of assets and liabilities is same, it doesn't matter if I use the same formula here. Okay, I mean, total of assets and total of liabilities are anyway same. So just copy pasting this. Look at this, just a simple control B everywhere. And you're good to go. Here you go. Your vertical financial statements are now ready. Okay, all of you see if you can do it. I will wait for 3-4 minutes. If you were not able to finish the balance sheet, then you try and do on whatever you've been able to finish. See if your formula is working the same way. Then we will analyze them together. And once you're done, give me a done on the chat box. And if you're not done, give me your progress in percentages, wherever you've reached. Sanchita says, can you explain something in Hindi? Sanchita, we've kind of global audience here. So therefore I'll refrain from using Hindi. से हिंदी मेरे को बहुत ज्यादा आता भी नहीं है, थोड़ा थोड़ा आता है, थोड़ा थोड़ा आता है, मतलब बहुत प्यारा हिंदी नहीं आता है, मुंबई पुणे टाइप का ब्रोकन हिंदी आता है. All right, Mohit, do it fast. I'm waiting for you. Wrap it up quickly. Okay, Mohit is done. Simran is done. This is how it should look like. You have your balance sheet here, and then you have a vertical analysis on your balance sheet. All right, then. Assuming you're done, let's start analyzing it. All of you stop doing what you're doing and just be with me here. Okay, spend some time on analysis, then I'll give you a break. In that break, you can kind of work on your Excel file as well. All right. So everyone observe this carefully, how this is happening. So total assets is 100%. Total equity and liability is also 100%. Okay. We want to know which are the most important items on the books. So out of my total 100 assets, 23.26% of the assets are coming in through property, plant, and equipment. So obviously that's an important number. So as an analyst, when I'm trying to model this company, I obviously want to spend some more time in understanding what is the decomposition of this PPE. What is that PPE made of? Is it land? Is it building? Is it factories? How will I know that? There is a notes to account, right? When we are looking at the PDF file, look at this. Here, my PDF should be visible to you. Where is it? Okay, here. I can go to note 1A and I can get a detailed schedule on property, plant, and equipment. Right now, we're not doing it. We're just identifying important assets. So here, the total assets are 23.26%. Capital work in progress is 2%. Right of use is 2%. Investment is a very insignificant amount. So in modeling, there is something called as a materiality threshold, which means you don't obsess about numbers which are insignificant. Right? You focus on what matters the most. So on this balance sheet, the most important number is goodwill. Look at this. I mean, how many balance sheets will you find in the world, I would say, where 35% of the balance sheet is made of goodwill, right? And as we know, goodwill is an intangible asset. Goodwill is something that you cannot see or touch or feel. Goodwill typically arises in case of acquisitions. Okay, what do you mean by this? Which means when one company acquires another company, at that time, whatever money they pay, some part of that money is towards the goodwill. So when you see goodwill on the balance sheet and when you see goodwill, which is very large, that should concern you a little bit. Which means if you and I decide to invest in Tata Coffee, we should spend a lot of time in investigating, why there is such a large goodwill on the books, and is that goodwill really legit, right? Is that goodwill, are we really comfortable with the number which they've put in the goodwill? If that goodwill is not legit, or if the goodwill, doesn't exist, and it's very difficult number to value. But if we feel that, goodwill is not good enough on the books, the firm at some stage in the future will impair them. Impair means reduce the value of goodwill. And when they reduce the value of goodwill, they will be required to show expenses. And when they show expenses, profitability will decrease. And if profitability decreases, probability that stock price will also, take a hit. So something that we need to be aware of, right? So we'll investigate more on goodwill. Then look at all the financial assets insignificant. There's a clutter on the balance sheet, but as an analyst, I don't even want to worry about them, right? Doesn't matter. Really, really small assets. But what is significant is inventories. That's about 15% of the books. So again, as an analyst, you want to spend some more time and you want to investigate this properly. Then we come down and look at this. Out of all the current assets that the firm has, the only two assets that matter is inventories and trade receivable, which is 7.95. So that's the beauty of doing vertical analysis. By quickly doing this analysis, you understand, which are the important numbers that I want to focus on and which are the numbers that I want to ignore. If I were to just take a total of these items, okay, this plus this plus this plus this, these four items contribute 82% of the balance sheet. And everything else, how many items that we have in total? If I just count these numbers, there are total 20 items on the asset side. So out of 20, 4 items contribute 82% and remaining 16 items contribute 18%. So you know where to focus on, right? You know that you need to focus on these 4 numbers. All right. Going to equities and liability. So total of these 3 is actually called as equity. Okay, so I can take a subtotal here as well on the percentage side. This is my equity. So about 54% of the balance sheet is made of equity. I've taken a total of these 3 percentages. The total of these is called equity. So 54, so about 55% is equity. Long-term loan, 13%. So there is a debt on the books, but it's not a scary level of debt, right? There is debt on the books. Look at this, 13.70, but not very scary. So again, you get a sense of how much debt firm has on the books. Then we have some other liabilities here. We have deferred tax liability, that's about 4%. But then we have a short-term borrowing as well. Look at this. So if I take long-term borrowing and short-term borrowing together, then the debt becomes sizable. Correct? So there is a 13% long-term debt, or 14% long-term debt, 14% short-term debt. So the 2 debt combined is a sizable number. And then we come downwards, and then we have a couple of items here, which is your accounts payable, which is about 4.62. And then we have other financial liabilities, which is 4.75. So there you go. That's your vertical analysis, a quick, easy way to get a sense of how the balance sheet is made of. So when we started looking at Tata Coffee balance sheet today, you look at these numbers, they don't give you a lot of insight, right? You say, okay, there is a goodwill, but it doesn't tell you the magnitude of this. But when you convert that into a vertical balance sheet, and that is the fastest and the easiest way to analyze any balance sheet, you get a sense of how the income balance sheet is made of. What are the most important assets and what are the most important liabilities? Did you understand this? Mm-hmm. Okay. Nice. So here's what I'm going to do. I'm going to give you a break now for we're not done with this analysis. We have to do a lot more. This is just the beginning. After this, I'm going to start doing some hardcore ratio analysis on the same balance sheet with you. But I'm going to give you a 10 minutes break. Put on the timer. In that window, you can do this, complete this vertical analysis. What I'll also do is share this file with you on the chat box. Okay, just give me a minute. Let me figure out how. Okay, I'll put on the timer. No, I can't do that. Just give me a minute. Let me figure out how I can do it. Maybe upload this on a Google Drive and share with you. Okay. So that at least in the second part of the session, we can work on the same file, right? So it becomes easier for everyone. Give me a minute. Correct. That's what I'm trying to do. I'm trying to upload this file and then share. Okay. I think I've been able to do it. Just give me a minute now. Putting it on your chat box. Okay. Uh, can you check if you're able to download the file from the link that I've shared? Can you please confirm if you can download the file? I've shared a link with you on the chat box. If you could confirm if you can download the file, fantastic. Okay. So I think that's how I'll keep on sharing files with you as we progress in this session. Great. So we take the first break now for about 10 minutes. I'm going to put on the timer. Keep on practicing with that Excel file, especially the ones who could not do it. And then after this, we'll start with some very interesting ratio analysis. All right. So I'm putting on the timer now. Here we go. So I'll see you in 10 minutes. All right, I'm ready when you are. Kindly make videos on AFM of ACCA. All right, Yusuf, noted. I'll look it up. Everyone, please come back. Are you enjoying the session so far? Okay. Let's start the next leg now. All right, here we go. Now we'll start doing some ratio analysis. The first thing we'll do is we will come on the equity and liability side, and then we will calculate total equity somewhere here. Okay. So I'm going to write that down here. Look at this. Total equity. How much is the total equity? Equity is a total of these three items. Which three items? Equity share capital, other equity, non-controlling interest. When I take total of these three, I get total equity. So total equity of this firm is 202,000. In rupees and lakhs, 1 lakh is, by the way, 100,000. So that's your total equity. Then we would go and take the borrowings. So first I will take long-term borrowings. Long-term borrowings, which is equal to long-term borrowings, which is equal to this number. Then we will take short-term borrowings, which is equal to this number, 51312. So we have long-term borrowings, we have short-term borrowings. Then we will say total borrowings. Okay, so we are taking entire spectrum of borrowings here, long-term as well as short-term, which is simply a total of long-term and short-term. So total borrowings is this number. Okay. Then we will calculate. Then we will take all the cash and cash-like items which are sitting on the firm books. And I'll tell you where I'm headed with this, but just be with me here for a minute. Okay. So we need to go and look at how much is the cash that the firm is sitting on. So let's see what we have. As far as the cash items are concerned, we have cash and cash equivalent. Then we also have some other bank balances, right? So we have these two items sitting in the cash, and then we have loans and investment and other items. So I'm going to take these two, cash and cash equivalent and other bank balances. So is equal to cash and cash equivalents is equal to other bank balances. This is called linking, by the way. Okay. And the beauty of the linking is that I can, okay, it would not work. There's a support column in between. All right. So I'm just linking the numbers as well. Then I would calculate the total cash that the firm is sitting on the books. So the total cash the firm is sitting on the books is this number. Okay. Now, assuming you're with me on this, we've calculated total borrowings, we have calculated total cash. Now, the first number that we would calculate is called the net debt. And you need to kind of learn to distinguish between what is the debt number and what is the net debt number, because a lot of times in ratio analysis we make use of the net debt. What does it mean? It means I do take the total borrowings, and observe my total borrowings here are 101,835, but then I'm also sitting on cash of about 18,000. Correct? So on a net debt basis, my net debt is going to be the difference of these two, which is the total borrowings minus the amount of cash I'm sitting on, and that becomes 83,742. So that's called as your net debt. I hope you've understood how I did this. I did total borrowings minus the total cash. So that's like your first ratio or first technical number for the day. Net debt, which is long-term borrowing minus cash. Why is this so important? Because if you look at some of the companies, maybe Apple as a point in case, if you go and download the balance sheets of Apple, you would see that there is some amount of debt, but there's also a large amount of cash. So if you just analyze on the debt basis, it doesn't make sense. What you want to do is you want to calculate debt, and then you want to calculate cash separately, take the difference of the two. That's called as a net debt. Now here's your first ratio. First ratio is net debt as a ratio to the total assets of the firm. Net debt as a ratio to total assets. How would you calculate this? 83,742 divided by the total assets and the total liabilities that the firm has, which is 36,889. So your net debt to total assets is control shift percentage, and maybe have a couple of decimals. So the total debt as a ratio to assets is about 22.70%. Now, what do you guys think? Do you want this number to be higher, or do you want this number to be lower? This net debt as a ratio to total assets, higher the better or lower the better? Just give me something, higher or lower, just type it in. Do you think higher the better or lower the better? Almost everyone on the chat box says lower the better, right? Not too high. Okay, there are a couple of people who are saying not too high, not too low. Ashwar is saying high. Lower shows a more stable company, not likely to be impacted by debt. Cannot show good arrow. See number. Okay. All right. So here's how we want to think, right? We always think that debt is a bad number. I think it's some sort of an influence that we have. We always look at debt from a negative perspective. But at times there are some businesses that you need to run on debt. Okay, I think just think of banking as a business. If there is no debt, banking as a business doesn't exist, because banks, what they do is they borrow from us at a cheaper rate in the form of deposits that we make, and take the same money and give loans at a higher rate. So banking business is essentially a business of leverage. But even some other businesses, for example, very capital intensive business, right? Certain businesses where you need to make significant amount of capital investment, some of these companies will have no choice but not to take debt. Debt lena hi padega, right? There's no option whatsoever. But what we need to know is that, have the firm taken debt that it cannot service? Have they taken too much of debt that if things go wrong, they'll not be able to survive? How much debt to take is also a function of the type of industry that you operate in. Okay. For example, I think one of my favorite examples in this space, there was a company in India in retail business called Subiksha. Okay, and at one stage, that company was really popular. Okay, Subiksha is kind of predecessor to your DMart and all those guys. Uh, and they were into retail business and they were expanding very rapidly. And the founder was very promoter. He used to be in the newspaper and all the time, and people used to write nice things about him, and the company was growing, expanding very fast. But what went wrong with Subiksha is that in the process of expanding fast, they ended up taking too much of debt. And what's the problem with debt? You need to service the debt. And how do you service the debt? You service the debt by paying interest. And what's so special about interest? It's a fixed cost, right? Fixed cost means it doesn't matter if you're making profit or not, you have to pay interest. At the same time, if you're in retail business, you're renting properties. And if you're renting properties, there is another fixed cost. What is that? Rent. It doesn't matter what business you're making, you have to pay rent. So that combination of fixed rent and the fixed interest resulted into demise of the company. And it is there are thousands of case studies, right? So many companies which have gone bankrupt because they went overboard with debt. Now, there is no magic formula in terms of what level of debt is good enough. But in this course, we will learn certain interesting ratios as we progress. Okay, for example, we will learn something called as a debt service coverage ratio, or we will learn something called as a debt by EBITDA ratio, or interest expense coverage ratio. We'll learn variety of ratios that will help us figure out whether the firm is in a comfortable shape or not. So I generally don't shy away from investing into debt companies, companies which have debt, but I don't invest into companies where I feel the debt is reached to a level where it's exorbitant, and now the firm will not be comfortable with it. Okay. So anyways, but that's your first metric for the debt. First metric, which is called net debt to total assets, is the next popular ratio. Let me give them a nice color to highlight them. Next popular ratio is net debt to equity. Net debt to equity. How do you calculate this? Is equal to, go and select net debt divided by go and select the equity number that we chose or calculated here, which is total equity. So look at my selection, net debt divided by total equity, and that number is turning out to be 0.41, which means whatever is the equity that the firm has, about 41% of that equity has come in the form of debt. So that's the next most important metric. Generally, these ratios as a group are given a name. Debt to total assets, debt to equity, we give them a name. Does anyone know what that name is? These group of ratios as a whole, they're called something. They're called as the leverage ratios. Okay, so these are your some of the leverage ratios. Okay. Solvency, yes, we can call them as solvency ratios as well. Yes, we can call them as solvency ratios as well. So leverage ratios or solvency ratios. All right. Let's calculate few more ratios. Let's go and look at what are the total current assets of the firm. Okay, so here I'm going to take a total of current assets. So we take the balance sheet and we divide them into current assets and non-current assets, right? So all these are your current assets. So we're going to take a total of all the current assets. So is equal to sum of, starting from here, 2 here. So your total of current assets are this number. Then we will go and calculate total current liabilities. Total of current liabilities. So that will be is equal to sum of. Go to current liabilities and take total starting with the borrowings up to other current liabilities. All right. So total of current assets, total of current liabilities. Now, generally, we calculate a number called as working capital. Okay. Can anyone quickly tell me how to calculate this working capital? How do you calculate working capital? Yeah, my total seems to be all right. Jesse, it starts with inventories, it goes up to non-current assets. That's right. So your working capital is current assets minus current liability. So is equal to this number and this number. Oh, you're right. I've taken non-current asset held for sale. What happens, Jesse, is because you're going to sell it within a year's time, this also is technically now a current asset. It was a non-current asset earlier, but now you expect that within a year you'll receive a cash from this. It can be treated as a current asset. So it's okay to include that 49.2 here in the calculation. All right, so that's my working capital, right? Which is simply current assets minus current liabilities. Now, there is also a ratio called as the current assets ratio. Sorry. There's a ratio called the current ratio. Does anyone know how to calculate this? Current ratio. Current ratio is calculated as, come on, help me out. That's right. Current assets divided by current liabilities. So this number is turning out to be 1.34. Now, what do you think? What do you think is an ideal current ratio? Do you want this number to be less than 0? Do you want it to be negative? Do you want it to be more than 0, more than 1, more than 2? What do you think is an ideal current ratio? I'm sure at some stage in your life, if you ever thought of studying finance, you probably have done current ratios somewhere, right? So tell me, what do you think is a good number for current ratio? Some people are saying, Sunil says more than 2, Mohit says 1, higher than 1, Sagar says 1, Akash says 1.5, Saksham says 1, 2:1. Yeah, that's what our textbooks, right? Schools, if you've taken a course on accounting some stage, that's what it teaches us, that current ratio should be more than 1, more than 2. See, in practice, that's not necessarily true. Okay, you'd find a lot of companies where current ratio is less than 1. And in fact, and what do you mean by current ratio being less than 1? Current ratio being less than 1 means your current liabilities are more than your current assets. And some companies are very proud of it. Some companies very proudly would come and say that we are a negative working capital company. Because just think about it. When you're doing a business, right, especially on the current asset and current liability side, how does it work? Let me draw it for you. So think that these are your liabilities, okay, and these are your assets. Now, on the liability front, the most important current liability is accounts payable. Accounts payable means these are the guys, these are the guys who are giving you goods on credit, okay, and maybe your accounts payable is 100. And then you have, typically your current assets broken down into inventories and accounts receivable. And your inventory and accounts receivable, at times you'll also have some cash. Now, if the total of these items is 150, you will say that my current ratio is 1.5. Okay, 150 divided by 100. But there will be cases where you would find that accounts payable is maybe let's say 200. Accounts payable is 200, and your inventory, accounts receivable and cash is 150. And in this case, your current ratio will become 200 by 150. Sorry, the other way around. 150 by 200. Okay, and how much will that be? That will be 0.75. Is that right? 0.75. That's less than 1. And less than 1 means you have a negative working capital here. Let me just delete this so that you will not be confused. It's a negative working capital. And some companies are proud of doing this. Some companies proudly say that, we operate on a negative working capital. And why is it such a proud thing to be? Like, why are companies so proud about it? Is because, and again, I want you to think of it this way. Okay, look at this carefully. When you normally start a business, right? How do you start a business? You put in your own money. Let's say you put in your own capital of 1,000. Out of this 1,000 capital, you might buy property, plant, and equipment of, let's say, 750, and you might invest in working capital of 250. Some of these companies which operate on negative working capital are very smart entities. Here's what they will do, right? So this is your positive working capital. What would be a negative working capital? A negative working capital will look like this. You invest your own capital of 1,000. Okay. Then you get accounts payable and you negotiate really smart with them. And let's say these accounts payable guys will give you 500. And then you go and buy property, plant, and equipment of 1,250. Remember, you invested capital of only 1,000. In fact, let me make this 1,300. So you go and buy property, plant, and equipment of 1,300, and you keep current assets, which is inventory, accounts receivable, cash of only 200, and then you rotate this. So technically, it's these guys, your accounts payable, who are funding your property, plant, and equipment. And these are the businesses which we say are operating on negative working capital. Now, can everyone do this? No. Is it always a good sign? No. If a company is in trouble, they will also have a negative working capital. But some companies, typically in FMCG space, when they buy from their suppliers, they negotiate credit of 3, 4, 5 months. But when they sell it to their customers, they receive cash within a month, and then they get to use that cash free of cost for a few months. Let me show you a few examples. Now, one of my favorite case study here is a FMCG company. Let me show it to you. That's right. Called Hindustan Unilever. So we'll go and download their annual report and we'll see what they have to say about their working capital in the most recent report. It's an Indian arm of Global Unilever. All right, let me search for the term working capital. Okay. Let me search negative working capital. Let's see if we can find it in their book somewhere. No. Let's search for current ratio. In fact, they have a positive number this year. Okay. So they used to have a negative working capital. It doesn't look like that's the case anymore. Can you see this? Current ratio is positive 1.3. Let me go back in the past and maybe download a historical annual report. I stopped tracking this number, this company in 2018. Let's see if I can get a 2017 type of a annual report. HUL 2017. Searching for negative working capital. Let's see if we find this command word anywhere. Let's look at current ratio. Searching for working capital now. Okay. I'm not able to find it directly on their books. Maybe it's some other year. Let's see if they've given ratios somewhere. It's on page number 4. Let me know if you spot current ratios or ratios anywhere here. Okay. Performance trends, business model, brands. Let me do one more search. Can you still hear me? Am I audible to you clearly? Okay, searching for it, searching for it. Wait a minute, let me go a year forward. Let me try the 2018 annual report. Maybe we'll find it here. Because I remember one of the annual reports, the chairman boasting that, we have a negative working capital. I just don't remember which year is that. Working capital. The sentence said something like, we continue to operate on negative working capital or something on those lines. No. If you guys can also look for other years, I'll keep on searching. Current ratio. Okay. Not 2019. What year was it? Not 2018. Let me try 2019. Let's try current ratio. Okay. 16, 17, 18, 19, it is more than 1. All right. Let me try, go back a little back in the past. Maybe let me try 2013 or 14. Maybe we'll find something here. Last attempt, otherwise I'm going to figure out a different way to do it. Okay, someone saying on the chat box it's in 2012. All right, let's go and check that then. Thank you, Mohit. I'm looking up 2012. Let's hope we'll find it here. Working capital. Yeah, okay. All right, fantastic. Finally, a lot of hard work for this. Would finally we found it. Look at what they're saying. We continue to drive cash delivery and sustained negative working capital in 2011, right? And that's something, that's their cash management practice. Kind of feeling proud about the fact that they had negative working capital. And when the working capital is negative, if they have done ratios, we should see, not current ratio, let me try quick ratio. No, okay. But if the working capital is negative, what do you think happens to current ratio? Current ratio obviously falls less than 1. But I think there's a way we can find out a list of companies with current ratios less than 1. We can simply write a screen, create a new screen. Let's see if there is a current ratio here. Okay, current ratio less than 1. Here we go. I will only take large companies. So current ratio less than 1 and market capitalization greater than 5,000. Current ratio less than 1 and market capitalization greater than 5,000. Okay. Give some interesting names. Look at this. That's a big list. How many companies in total? We have 82 companies. Let me go even bigger. Let me take market capitalization more than 10,000. Here we go. Some interesting companies here. In fact, even Britannia, for that matter, has a negative working capital. I'm just taking some of the popular names. Varun Beverages, Devyani International, Ultratech, Hudson, Torrent. Plenty of companies with sizable business operating on negative working capital. So, anyways, you get the idea, right? The idea is, again, no rules with working capital. Generally, the current assets will be more than current liabilities. So, working capital will be positive, but there will be some cases you'd encounter some companies where working capital could be negative. All right. And current ratio is what type of ratio, by the way? Current ratio is what category of ratio? Current ratio is what category of ratio? It is the liquidity ratio. That's right. It's called the liquidity ratios. We generally also calculate, some quick ratio, asset test ratio, cash ratio, but this is the one that you need to know for the timing, the most important one. The category is called the current ratio. All right, good. So this is pretty much what I wanted to cover in today's session. Just get you introduced with how balance sheet is built. get the structure in your mind. Now, let me give you some sort of a to-do list for the week. Remember, we're doing total 3 sessions on YouTube. The first session we dealt with income statement. The second session we dealt with balance sheet. Now, in the next session, we're going to deal with income statement and balance sheet together. Okay, so we will be doing income statement and balance sheet integrated analysis. So in the next session, we will be learning some very cool ratios like ROE, ROC, return on equity, return on capital, return on invested capital, asset turnover ratio. We'll be looking at cross statement ratio, some number from income statement, some number from balance sheet. We'll be kind of mixing them together. All right, so it's going to be a lot of fun. Don't miss that session. The work that I have for you this week is, again, fairly basic. Those of you who are absolute beginners, go on the FinTree site and complete the level 0 course. Okay, those of you who have no background in finance whatsoever, level 0 is a free course, so you should be able to kind of enroll yourself directly. It will ask you for a code. The code is FinTree 2022. Okay, so go to level 0 program, finish it. It will help you quite a bit. You would learn, this is the code, FinTree 2022, F capital, T capital. It will tell you basic stuff on accounting, ratio analysis, stock market, derivative, everything, all the basics. Now, those of you who've already got access to financial modeling, we can make good use of this time before we start going aggressive. This week, I want you to go to this module called the Art of Stock Picking. Okay, it's a part of financial modeling. So go to Art of Stock Picking. In Art of Stock Picking, you'd find some really useful content. So here, I've discussed how to pick up stocks, right? So there's a discussion on stock picking. There's a discussion on idea generation. How do you generate ideas from different sources? Then there is a video of 51 minutes on how to make use of screener.in. Then there is an assignment. There is some discussion on, screening assignment. Then you would find some very useful videos on annual report analysis. You would find videos on PPE. This week in particular, what I want you to do is go to day 8 and day 9 and day 10. Okay, 8, 9, and 10. What I've done here is I've done book reviews of some of my favorite books on stock market. These are the books from Peter Lynch, One Up on Wall Street. Okay, so I've not only done book reviews, but I've literally taught some of the interesting concepts in there. So you can see these are fairly long videos, but watch them before the modeling class starts. The technical part, go and spend some time on them because you'd really enjoy it and you'd learn to think like a fund manager. Then there is another one of my favorite books on stock market called The Little Book That Builds Wealth. This book is revolved around the concept of moat. Why moat is so important in understanding stocks. So spend some time on this. This will take you about a couple of hours, 2.5 hours. And then there is another Peter Lynch book called Beating the Street. So spend some time on these books so that you kind of start getting the vibe and the direction in which the course is moving. All right. So with this, the session is formally over. I hope you guys enjoyed the class. The final version of this Excel file, I'll upload this in the description of this video. So you can come a little later when the video is live on YouTube and download this from the description directly. Right. I hope you enjoyed the class. I hope you found it useful. Thank you very much. I appreciate the valuable time that you invested. And I'll see you next week, same time, for the final session on YouTube, where in the next session, we will take one income statement, one balance sheet, and then do a complete ratio analysis end to end on income statement, on balance sheet, and all the cross ratios. Okay, so with this, thank you very much. See you next week, same time.